An S-Corp owner is netting $280,000 per year. He pays himself a W-2 salary of $18,000, the minimum he thought he could get away with, and takes the rest as distributions. He saves roughly $40,000 in self-employment taxes. The IRS audits him, determines his reasonable compensation should be $120,000, and bills him $15,800 in back payroll taxes plus interest and penalties. He saved money in the short run and paid triple in the long. How you pay yourself is one of the most scrutinized decisions on your business return. The way you pay yourself as an owner depends entirely on your business entity type. Sole proprietors and single-member LLCs taxed as sole proprietorships don't have a salary. You simply withdraw money from the business account. This is called an owner's draw. Partners in a partnership receive guaranteed payments or their share of profit. S-Corp owners must receive a reasonable W-2 salary for services rendered before taking distributions. C-Corp owners are employees of their own corporation and are paid on W-2. Getting this wrong is not a technicality, it is a tax error with real penalties. For sole proprietors, the tax implications are straightforward and unforgiving. All net profit on Schedule C is subject to self-employment tax, 15.3% on the first $168,600 in 2024, and 2.9% on everything above that. An owner's draw does not reduce your taxable income. You pay self-employment tax on profit, not on what you take home. Pulling $50,000 as a draw from a $150,000 profit business doesn't reduce your SE tax. The full $150,000 is on the hook. This is why entity structure matters before you start scaling. The S-Corp structure reduces self-employment tax by splitting owner income between salary and distributions. Salary is subject to payroll taxes, both the employer and employee halves of FICA. Distributions are not subject to self-employment tax. So an S-Corp owner earning $200,000 who takes a $90,000 salary pays payroll taxes on $90,000 and avoids SE tax on the remaining $110,000 in distributions. At 15.3%, that's roughly $16,800 in annual savings after accounting for S-Corp administrative costs of $2,000 to $5,000 per year. The IRS defines reasonable compensation for S-Corp owners as what you would pay a third party to perform your role in the business. They look at comparable salaries in your industry, your geographic market, the complexity of your duties, and what percentage of revenue you personally generate. There is no bright-line dollar figure. The IRS has pursued cases involving owner salaries as low as $0, where all profits were taken as distributions and won. A 2012 tax court case, David E. Watson, resulted in a $68,000 tax bill after the IRS reclassified distributions as wages. A benchmark used by many CPAs is the 60-40 split, 60% of S-Corp distributions taken as salary, 40% as distributions. This is not an IRS-approved safe harbor. It is a practitioner rule of thumb with no legal authority. A better approach is to document your methodology using BLS Bureau of Labor Statistics wage data for your occupation and region, then set a salary at or above the median. Keep a written compensation analysis in your corporate records. If audited, you want evidence that the salary decision was deliberate and grounded in market data. Quarterly payroll taxes are required once you take an S-Corp salary. You must file Form 941 quarterly, remit employer and employee FICA, and issue yourself a W-2 at year-end. Missing payroll deposits triggers a failure to deposit penalty of 2 to 15% depending on how late the deposit is. Running payroll for one owner is not complex. Payroll services like Gusto, ADP Run, or QuickBooks. Payroll handle it for $50 to $80 per month. That cost is fully deductible and eliminates the penalty risk from self-managed payroll. Owner's draw for sole proprietors and LLC members has no tax consequence at the point of withdrawal, but it does carry an accounting obligation. Every draw should be recorded as an owner's equity transaction in your books, not as a business expense. Treating owner withdrawals as business expenses will overstate your deductions, understate your profit, and create discrepancies that trigger scrutiny during a review. Use separate line items in your chart of accounts, owner's draw, or member distribution. Your bookkeeping software has this built in. Use it correctly from day one. For retirement purposes, how you pay yourself directly affects how much you can contribute. Solo 401k employee contributions are capped at $23,000 for 2024, but only on earned income. S-Corp distributions are not earned income for retirement contribution purposes. Only your W-2 salary counts. An owner with a $50,000 salary can contribute $23,000 as the employee plus a 25% employer match, $12,500, for a total of $35,500. An owner who minimizes salary to $18,000 can only contribute $18,000 as the employee deferral. Your salary decision has compounding retirement consequences. How you pay yourself is one of 3 decisions that define your annual tax position, the others being your entity structure and your retirement contribution strategy. Set a documented, reasonable compensation before tax season arrives. Use payroll software. Keep your draws properly categorized. For a deeper look at how entity structure intersects with these decisions, the video on LLC versus S-Corp breaks down the full cost-benefit at different income levels. Reasonable compensation is only half the picture. The other half is the entity wrapper that makes the salary versus distribution split possible in the first place. If this gave you something to act on, LLC versus S-Corp, the exact profit level where switching saves you money goes further. It is on this channel.